Hey everyone, we're going to talk through chapter 9 since I am not there to talk to you about it in person. So, chapter 9 explores critical components of business taxation, focusing on income, deductions, and accounting methodologies. We'll review common deductions, identify statutory limits, compare accounting methods for tax purposes, including cash versus accrual methods. Understanding these aspects is essential for accurate financial planning and compliance. We have four objectives in this chapter. So, identifying common business deductions, determining the limits on deducting business expenses, describe accounting periods available to business, and applying cash and accrual methods to determine business income and expense deductions. Excuse me. So here's a breakdown of how this works with, first of all, the gross receipts test. For businesses, gross receipts cannot exceed $30 million dollars for the 3-year period preceding the current year. So there is a $30 million threshold. So to qualify for the cash method of accounting, that's specifically what we're talking about here. I should have said that first. To qualify for the cash method of accounting, a business's gross receipts must not exceed $30 million dollars across the 3 preceding years. This threshold helps determine if a business can use cash accounting instead of accrual accounting. And the reason a business would want to use cash accounting is typically simpler than accrual accounting. If a business hasn't been in operation for 3 full years, it uses the data available for its operational period. So, for example, a business with only 2 years of eligibility, of 2 years of gross receipts, would use those 2 years to determine eligibility. We're also annualizing short year receipts. When a business has operated for less than a full fiscal year, the gross receipts need to be annualized. So this is done by multiplying the gross receipts by 12 and then dividing by the number of months in the short period. This process gives an estimate of what the business's gross receipts would look like over a full year. We're also looking at exclusions of tax shelters. Tax shelters cannot qualify under this gross receipts test to see if we can do cash versus accrual. This is due to stricter tax regulations aimed at preventing tax shelters from taking advantage of more favorable accounting methods. This test ensures that only qualifying businesses can use the cash accounting method, and this provides flexibility in recognizing income and expenses based on cash flow. So, Bluecore began business on July 1st last year and reports gross receipts of $14 million. dollars. Can Blue use the cash method this year? Yes or no? Why or why not? So this is kind of what this would look like. We have 14 million and it's not been a full year. So times 12 months. And then we're going to divide that whole thing by 6. So Bluecore, their gross receipts of 14 million are below the $30 million threshold. And since it began its business since last year, it doesn't have the full 3-year history. We're going to see, we're going to extrapolate that out to a full year. So 14 times 12 divided by 6 gives us $28 million. So yes, they can use the gross receipts, or sorry, they can use the cash method this year. Let's talk about business income and deductions. Deductions need to be directly connected to business activity. To qualify as a deductible expense, the cost must be closely tied to the operations of the business. This means that the expense should be directly associated with generating income or supporting the core functions of the business. So examples here would be things like rent for office space, salaries for employee, the cost of goods sold, personal expenses or costs not directly related to the business's operations, generally not deductible. Business expenditures also need to be both ordinary and necessary to be deductible. An ordinary expense is one that is common and accepted within the specific industry. For example, if you own a landscaping business, costs related to buying plants or maintaining landscaping equipment would be considered ordinary expenses. A necessary expense is one that is helpful and appropriate for the business. It does it doesn't have to be indispensable, but should be useful in achieving the business's goals. Necessary expenses help the business operate effectively or contribute to profit generation. So ordinary and necessary means conducive to profit generation. Expenses need to support the goal of making a profit. The IRS applies this concept to ensure that businesses are deducting costs that actually further their profit-making activities. For instance, if a business spends on marketing campaigns or training sessions, these are generally deductible because they support revenue growth or operational efficiency. And again, reasonable in amount means not extravagant. Deductible expenses should be reasonable, meaning they should not be excessively large in proportion to what is typical for a similar expense. The IRS evaluates reasonableness to prevent taxpayers from deducting overly generous or inflated expenses. So, an example here, if a business owner rents an office for $50,000 a month in an area where typical rents are only $5,000 a month, the IRS might disallow part of this expense for deduction as unreasonable. Another example of this that we see a little more often is suppose that Rick hires his brother Tom to work in his company, and he pays him $10 more per hour than other employees for similar work. A little nepotism happening here. Even if this extra payment helps Tom financially, the IRS may see it as unreasonable and consider this extra $10 an hour as a personal gift rather than a deductible business expense. Only the reasonable part of Tom's wages would be allowed as a deduction. In summary, these requirements ensure that business deductions reflect true business needs and reasonable spending. And these principles are intended to prevent abuses in deducting personal or really extravagant expenses that don't genuinely contribute to profit generation. So another example here, Rick hired his brother Tom on a part-time basis. Tom performed the same duties as other part-time employees, but Rick paid Tom an extra $5 per hour to provide support for Tom's education. At year end, Tom had worked a total of 100 hours and received $2,500 from Rick. What amount can Rick deduct from the compensation he paid to his part-time employees? Rick cannot deduct the extra $5 an hour for Tom's compensation because it is unreasonable in amount. Thus, about $500, so 5 times 100, is considered a personal, non-deductible gift from Rick to Tom. Hence, Rick can deduct $2,000 for compensation expense this year for Tom. Now, if Rick had a employee education program set up where he gave money to employees for continuing education, different story. That's not what's happening here, though. Let's talk about statutory limits on business expense deductions. So first, expenditures against public policy. There's no deduction for certain expenses. So for example, businesses cannot deduct expenses that go against public policy, such as fines, bribes, lobbying expenses, or political contributions. The IRS prohibits these deductions to discourage illegal or unethical activities and to prevent taxpayers from using such costs to reduce their taxable income. Fines and penalties includes any fines or penalties paid to a government for breaking the law. Bribes, any payments to influence or I can't talk today, guys. Influence or corrupt government officials are not deductible. Money spent on lobbying or donations to political campaigns cannot be deducted as they are not considered ordinary and necessary expenses for generating business income. Expenses relating to tax-exempt income. So there's some things here like non-deductibility. Expenses related to generating tax-exempt income are non-deductible as they don't contribute to taxable income. Interest on loans for tax-exempt investments. If a business borrows money to invest in tax-exempt securities like municipal bonds, the interest expense on that loan is not deductible. So this prevents businesses from getting a tax benefit on income that's already exempt from taxes. Key employee insurance premiums. Premiums paid on life insurance policies for key employees are not deductible if the business is the beneficiary. There are companies that, especially for CEO, like large companies, will set up life insurance policies for CEOs, members of their executive staff, where the company is the beneficiary, because the company has to find someone to replace that person if that person dies. This doesn't mean that they also don't have life insurance policies that would go towards the family, but they can't deduct this on their taxes if the company is the beneficiary. In most cases, the proceeds received from a life insurance policy where the business is the beneficiary is not tax deductible. Capital expenditures. There's a capitalization requirement. Capital expenditures, which are investments that provide future benefits, such as acquiring or improving a long-term asset, must be capitalized rather than expensed. This means that they are added to the basis of the asset and depreciated or amortized over its useful life. So buying new equipment, buildings, or making major improvements, unlike regular business expenses, capital expenditures provide benefits over multiple years, and we're spreading that over the asset's useful life. So we're going to deduct depreciation expense later, but we're not going to deduct that entire capital expenditure at one time. Personal expenditures. There are no deduction for personal expenses. Personal expenditures that do not relate to business operations are not deductible. These include costs for personal travel, meals, clothing, unless it's specifically required for the job and not suitable for everyday wear, and other non-business related expenses. If an expense has both personal and business components, such as travel or meals, only the business portion can be deducted. There's a limitation on business interest deduction. Business interest deduction has a cap. The IRS limits the deduction for business interest expense to discourage excessive leveraging and to ensure fair taxation. For most businesses, the limit is the sum of business interest income plus 30% of the adjusted taxable income. Businesses with average annual gross receipts of $30 million or less over the previous 3 years are exempt from this limit. Adjusted taxable income is calculated by adding back certain deductions, including depreciation, amortization, and net operating losses. We have losses on dispositions of business property. So deductible losses on the sale of disposable or business property are generally deductible. However, if the loss involves a sale to a related party, such as a family member or another who is controlled by the taxpayer, it's not deductible. Casualty losses for business property damaged or destroyed by a casualty, such as a fire or a natural disaster. The deductible loss is limited to the lesser of the decline in value or the cost to repair, or the adjusted basis in the property. If the asset is completely destroyed, the loss is limited to the asset's adjusted basis. So each of these categories reflects the IRS's approach to ensuring deductions are only taken for legitimate business expenses that align with the principles of fair taxation. So we're talking about capital expenditures. Does the expenditure provide future benefit beyond this year? If so, we want to capitalize it rather than deducted as an expense. When a business makes an expenditure, it must determine whether the benefit extends beyond the current tax year. If the expenditure provides a future benefit lasting beyond the year it was paid, it is capitalized rather than expensed. Capitalizing means recording the expense as an asset on the balance sheet, which is then amortized or depreciated over its useful life. This process again spreads out expense over the years in which it contributes to generating revenue. So if a business buys equipment that it's going to use for several years, it needs to capitalize the cost and depreciate it over time rather than deducting the entire amount in the purchase year. Excuse me. For prepaid expenses, there is a 12-month rule. The 12-month rule allows businesses to deduct certain prepaid expenses in the current tax year if the benefit lasts 12 months or less and the benefit does not extend beyond the end of the next tax year. So this rule simplifies the treatment of short-term prepaid expenses as it avoids the need for complex amortization schedules for items that are going to be used up in a really short period of time. For example, if a business prepays for 10 months of insurance coverage starting in March of the current year, the business can deduct the entire amount in the current year because the benefit period is less than 12 months and does not extend beyond the end of the next tax year. The 12-month rule does not apply, though, to interest expense. Interest must generally be expensed as incurred or paid, depending on whether the taxpayer is using the cash or the accrual method, rather than capitalized or deducted in advance. This is because interest relates to the cost of financing, which accrues over time, rather than providing a discrete period of benefit like a prepaid asset might. For example, if a business takes out a loan and prepays interest for the following year, it cannot deduct that interest all at once. Instead, it must allocate interest deductions across the period to which the interest applies. For accrual basis taxpayers, the 12-month rule can be more complicated due to economic performance requirements. Under the accrual method, an expense can only be deducted when economic performance occurs, meaning the service or benefit has actually been provided or fulfilled. This means that even if an expense is prepaid, the accrual method may not allow immediate deduction until the service or benefit is realized. So, for example, if an accrual basis taxpayer prepares for maintenance services to be completed in the following year, the deduction would be deferred until the service is actually provided, regardless of this 12-month rule. So let's look at Ben, who's a cash basis taxpayer, and he makes the following payments on June 30th of this year. $10,000 for the next 10 months of utilities, $12,000 for insurance, and $9,600 for the next 8 months of interest on a business loan. What amounts are deductible from this year? Okay. So first, the $10,000 deductible. The benefit does not exceed 12 months. It doesn't extend beyond the next year. For the insurance, this one exceeds 12 months. See, we're going into 24 months here. So Ben can only deduct 6 months for this year. So if it's 12,000 over 24 months, that's $500 a month. So for 6 months, we would get $3,000. So we have 10,000 and we have 3,000. The $9,600. The 12-month rule does not apply to interest. So we can deduct some of this $9,600. Let's check out the next page to look at why. So Ben can deduct $7,200 of interest. He had $9,600 for 8 months, but there's only 6 months left in the year. So 9,600 divided by 8 months times the 6 months that are left gives us $7,200. So 10,000, 3,000, and 7,200. No business deduction. So some more business expenses, some more business expense rules here, especially with personal benefits. The IRS does not allow deductions for expenses that are purely personal in nature. So, for example, um, personal living expenses, non-business related travel, and purely personal meals. This rule ensures that business deductions are only allowed, sorry, for expenses directly related to business operations. Some expenses have both personal and business purposes. So a trip that combines both business meetings and vacation time. In these cases, only the business portion is deductible. Mixed motive expenses require careful documentation to differentiate the business related and personal portions. For some expenditures, the IRS examines the primary motive to decide if the expense is deductible. If the primary motive is business, the expense may be deductible. If the primary motive is personal, the deduction could be disallowed. For certain expenses like business travel, the primary purpose must be business for the IRS to allow any deduction. If the primary purpose is personal, the entire expense would be disallowed. Travel expenses are deductible if the trip's primary purpose is business and the travel takes the taxpayer away from home overnight. Deductible travel expenses may include transportation, lodging, meals. However, the trip has both business and personal elements. Only the portion related to business activities is deductible. When expenses cover both business and personal purposes, they should be prorated based on business usage. For example, if a vehicle is used for both personal and business travel, the expense should be allocated proportionally based on miles driven for the business. So that means you need to keep track of your mileage if you're using that vehicle for both personal and business. Meals have a 50% deductibility. So for business meals, the IRS allows only a 50% deduction. This rule applies to meals consumed during business travel or for those provided to clients or employees as part of business-related activities. For a meal to qualify, it must not be lavish or extravagant and should involve substantive business discussion. Business expenses must be allocated based on an appropriate basis, such as mileage for vehicles or time spent for mixed-use travel. For instance, if a car is used for 60% business and 40% personal use, then 60% of the car expenses are deductible. Thorough documentation is essential here for business deductions. Taxpayers need to keep receipts, logs, other records to substantiate expenses, especially for mixed motive expenses. So, mileage logs for vehicles, receipts for travel and meals, any supporting document showing the business purpose of the expenditure. The IRS requires that business purpose be clearly documented for expenses to qualify as deductions. So this could include notations on receipts, written descriptions and logs, or explanations attached to expense reports. Proper documentation can help clarify the business portion of mixed motive expenses. So, Ben paid the following to attend a business meeting in Chicago. Airfare, first class, $1,200. Hotel, 3 nights, $750. Meals, 3 days, $270. What amounts are deductible if Ben spent 2 days in meetings, primarily business? What amounts are deductible if Ben spent 1 day in a meeting, primarily personal? And what amounts are deductible if the meals were provided by a restaurant outside of the meetings? So, for the primarily business, all the airfare could be deducted. The hotel, up to $250 a day. The meals, $90 per day at 50%, so 2 days. You only get $90 off there. So total travel deduction if it's primarily business, $1,790. If the trip was primarily personal, airfare, it's either all or none, so zero airfare. Hotel, $250 a day. It was a 1 day trip for personal, so $250. $90 a day. It was a 1 day trip for the personal one, so 45. So the total we could get there would be 295. Cost of meals would be 50% deductible regardless of whether provided by a restaurant because the meetings are away from home and overnight. Business interest limitations. The business interest expense limitation restricts the amount of business interest expense that certain businesses can deduct. This rule was introduced to curb excessive interest deductions and primarily impacts larger businesses. However, it does not apply to businesses with average annual gross receipts of $30 million or less over the prior 3 years, commonly referred to as the gross receipts test, which we talked about all the way back at the beginning of this chapter. The deduction limit calculation. For businesses that do not meet the gross receipts test, their average annual gross receipts exceed $30 million. The deductible business interest expense is limited to the sum of business interest income, any interest income the business earns, 30% of adjusted taxable income. This is a key adjustment that reduces overall interest deduction. Um, so we're going to subtract interest income. Since the goal is to limit the net business interest deduction, any interest income which offsets the interest expense is removed. We're going to add that back in later on, and we're going to add any net operating loss deductions. So let's look at an example. This year, MH reported $200,000 of taxable income on $30 million of revenue. The revenue included $20,000 of interest income. In calculating the taxable income, MH deducted $240,000 of depreciation and $210,000 of interest expense. What is MH's maximum business interest deduction this year? So first, we have taxable income of $200,000. We're going to subtract the $20,000. We're going to add the interest expense. That gives us an adjusted taxable income of $390,000. We're going to multiply that by 30%. There's 117,000. And then we're going to add the interest income back in. So we're up to 137,000. When we sell or dispose of an asset, any loss realized from the sale, can typically be deducted. These recognized losses reduce taxable income and are intended to reflect economic loss the business experienced. The IRS disallows deductions for losses on sales of assets between related parties, such as family members or entities with shared ownership. This rule prevents tax avoidance schemes where taxpayers might sell assets at a loss within a family or controlled entity simply to gain a tax deduction. Casualty losses occur when business property is damaged or destroyed due to unexpected events like natural disasters or accidents. And again, we've already talked about what that is. And then basis and total loss. If a business asset is completely destroyed, the deductible loss is the asset's entire adjusted basis. So this allows the business to recover if it's its investment in the asset for tax purposes. So we've looked at business gross income and deductible expenses, and now we need to match income and deductions to a specific period. So this is accounting methods. This is where we're picking accounting methods. First, let's talk about accounting periods, though. A full tax year is 12 months long. A short tax year is less than 12 months. So if a new business starts, or sometimes a business can change its tax year. Year ends, a calendar year ends on 12/31. That doesn't have to be when the business ends, though. Our fiscal year end, it depends upon our choice. It's the last day of the month, not December. And sometimes there's a 52, 53 week year end. Could be the same day. Sorry, I didn't mean to cross through that. The same day of a specific month there. When choosing an accounting period, proprietorships are going to be the same as the proprietor's year end. So if you own your own business, and it's a small business, your year end is going to be the same as when you file your taxes. So December 31st. C corporations and individuals make a choice on the first tax return, and it has to be consistent with their accounting period. Flow through entities have a required tax year, so it matches to the owner's period Multiple owners for partnerships sometimes can make it really complicated. Financial and tax accounting methods. In reporting financial statement income, businesses have incentives to select accounting methods permissible under GAAP that accelerate income and defer deductions. In contrast, for tax planning purposes, businesses have incentives to choose accounting methods that defer income and accelerate deductions. So our two methods here, the permissible overall methods, are either cash, recognize income when received, or accrual, recognize income when earned or received, whichever is first. Large corporations and partnerships with corporate partners must use accrual. If you're a publicly traded company, you must use accrual accounting. It is required under GAAP. Taxpayers that satisfy the gross receipts test can elect the tax method, though. The cash method, income is recognized when actually or constructually received. So expenses are recognized when paid. The cash method is really flexible, it's really simple, it's relatively inexpensive to set up. However, there's really poor matching of income to expenses. And you can use accrual for some accounts, so there's some hybrid options there, but it can be used by taxpayers who satisfy the gross receipts test. The reason people use the cash method is that it's just way easier to understand. Accrual income is recognized when earned or received. Ooh, I clicked a button. All events test. So this is recognizing income when all the events have occurred that fix the right to receive such income. And the amount can be determined with reasonable accuracy. So we recognize it on the earliest of these dates down here. Either complete service or sale, the payment is due, or the payment is received. So Ben provides consulting services and bills for Ace for $12,000. Ace disputes the amount, claiming that $8,000 is the proper amount. How much income should Ben recognize under the accrual accounting method? So the answer here would be the $8,000 because revenue would be contingent on the claim that's under dispute. So we'd have to wait till that claim was no longer under dispute and that was resolved to recognize the other 4,000. Advance payments for goods and service with accrual are allowed to defer recognition for 1 year unless income is earned or recognized for financial records. They're not applicable. Oh, I can't talk. They're not applicable to payments relating to rent or interest income. And again, this is an accounting method election that cannot be changed without the permission of the IRS. So if Ben provides dancing lessons on September 30th of this year, he received $2,400 full payment for a 2-year service contract. What amount of income must Ben recognize if he's on the cash method, if he's on the accrual method? If Ben uses the cash method, he must recognize income as received, so $2,400 for this year. If he uses the accrual method, he can elect to defer advances for services for a year. So Ben would recognize $300, the income earned from December, and the next year Ben would recognize the remaining $2,100 income, as income can only be deferred 1 year. For business expenses, again, there's an all events test. So all events have occurred to establish the liability to pay. The amount is determinable with reasonable accuracy, and reserves for future liabilities are not allowed. And whatever it is, the transaction, the economic performance, it has occurred already. So an example, Ben has signed a binding contract for Peter to provide Ben with repair services. Ben paid $1,500 to Peter and owes an additional $6,000 on the contract. The repairs will commence late next year. What can Ben claim the deduction? What can Ben claim as a deduction if he uses the accrual method? The Allman's test is satisfied. Ben signed the contract and owes $7,500. However, this falls under a service provided to the taxpayer, and economic performance is the service as the service is provided. Sorry. Hence, Ben deducts $7,500 next year. So the $1,500 is a prepaid expense. It doesn't qualify for the 12-month rule. And he could deduct $7,500 if he paid the entire amount and expects the repairs to be completed within 3.5 months. All right, that is all for this particular chapter. Thank you for listening, and I will see you in class.